Recording.
Yeah. Okay, there we go. We're recording. Okay, now we're all good.
Super.
Okay, lovely. I'm going to take this trading view and then I'm going to share screen. How was your trading week last week since we last spoke?
To be very honest, James, I have not taken any trades. I was up to something else.
Okay.
It's now that I'm looking to settle down and hopefully now start taking some trades. There's something that I was doing that took me off from chat.
Okay. No problem.
But such is life, you know.
Yeah, it happens for sure.
Yes.
Okay, perfect. I'm going to share screen. Okay.
Yes.
Let's start with Euro USD, right?
Right.
Okay, so we're on the 12-hour time frame now.
12 hour.
Yes. Okay.
Okay.
So remember that concept we've been speaking of the whole time. Kind of you want to play off the area that caused a new high.
Yes.
So in this instance, right, Euro USD failed to make a higher high. So we have a high here.
Yes.
Then we have a lower high here. But remember, we never made a lower low. So technically we're still bullish. So if we go to the daily time frame, right, we failed to make a lower low on the daily because we have, this is the origin, right?
Yes.
That we always speak about. So this is where your initial, that's where you want to take your trades off of. So we came into that area. Now we rallied, right? And we took out these highs here.
Yes.
Took out this supply zone here as well. These two areas.
Right.
So these are obviously very significant areas. Now, where can we expect the pullback to either create a new high, right? Because we haven't created a new low. So let's think. The area we always speak about is a slingshot over here. So this is the accumulation, the reaccumulation that caused this high over here and this high over here. So now we know we're going to get a very strong reaction off of this, right?
Yes.
So this is our points of interest. You can simply just pull a fib, right? And then look at the 50% because we know we're going to get a reaction off of that. So here we can mark off the 50% and let's see what happened. So you see, we tapped into that and now we're reacting. We're starting to kind of create this pin bar. So if we go to the lower time frame, drop down maybe to the 4 hour, we can start looking, okay, is there anything in here that attracts us? Is there anything that gets our interest, right? Something unmitigated. So over here, we kind of have a liquidity sweep, this candle. So I'm going to put us into replay mode. Okay, so we created liquidity, yeah. Right, all of these equal lows, 1, 2, 3. So we made a triple bottom, took that liquidity, right? So let's drop down more. So you always want to start on the higher time frame, and then you just do this kind of dropping down to a lower and lower time frame because we want there's specific things we want to see. We're looking for a sponsor candle on a certain time frame. So we're trying to make a clear picture for ourselves to know what we should be trading off of. That's what I always do. I flip through every time frame and I'm looking for something on that time frame that interests me, right? That I know I can take a trade off of. So unfortunately, right, for that area there, we can't drop down to the lowest time frame because of we don't have enough data. So we kind of have to figure out, okay, let's go back to this point. Now, in this area here, this low, we have to find something on a time frame that we can work with. So let's go back here because this is our POI. So, okay, we've checked most of the time frames. So I'm going to go back to the hourly. And this is what looks the best to me so far. This imbalance fill and pin bar. 2 hourly. Sorry, I just want to mark off 2 areas. I want to mark the 80% of this move off. Swept liquidity, so I'm going to mark that off there. The 80% retracement is really good on a candle that swept liquidity. Kind of your highest probability area, so I'll always try and play off that. Okay.
So where do you take your fits from, Charlie, when you're looking for the 50 and 80%?
where do I pull it from? The low that swept liquidity. So we had all these equal lows and this low took it out. And this was a move that caused it.
So you take from the body or from the wicks?
I include the wicks always, because the wick on this time frame, right?
Right.
The wick on one time frame is the body on a different time frame.
Uh-huh.
All right, so here's our two POIs. We mark off the 80% and the 50%.
Right.
All right, so these are areas of interest right here. Now, what I'm going to be looking for is fractal accumulation. So I want price to come into this area.
Right.
And I want to see an accumulation take place. So this is my area of interest. I really like these areas. Now, if we go back to current price, this is what we're going to be waiting for. I want price to come into this area.
Right.
Yeah, exactly. So we kind of need to think, right? I don't think price is going to go long from here because there's no reason, right? There's nothing here. That's the 50%, but we kind of traded through it. Yes. We dropped onto the 1 minute time frame. We can see a really strong reaction, but that's because look at the imbalance we created. So we're more than likely just going to trickle up, fill the imbalance, and trade into some form of supply zone that will take us short. And the only supply zone that I can see that's really significant in this one, or if you look at the 50% of this move, yeah, kind of see this supply lines up really well with the 50%.
Okay.
Okay, now let's get this fib right. Okay. So now we've got quite a bit of confluence. We have the 50% here that's going to cause a reaction. If price gets to this area, we are bearish. And then we have a POI lower. So what I'm thinking is we're going to come into this area. So let's go to the 5 minute time frame and we should see a very nice candle here. Look at that OB, buy to sell. So we bought up here before we had significant supply in the market. So I really like this area for shorts because we are overall bearish. 6 minute time frame looks really good. And 7 minutes. Oh, that is perfect. I'm going to drop to 8 minutes. Okay. So the 7 minute time frame gives us a really beautiful picture. Now, you can very happily take a trade off here, the imbalance full, and you've got this OB here supporting you, stops above this. Okay, because this is significant supply, because price could push up into this pin bar. See that to fill this imbalance. So we could push through this because a lot of traders trading smart money, etc., are going to have their sun limit here because this is a significant area and they're going to put their stop losses here. Right, so we might just wick above this and this might hold, or if you want to be conservative, always put your stop loss above the swing high. Just depends if you want to be trading high or so that's significant. The only issue with this is we might not make it to this area, this supply here, because this is a supply that caused us to break this demand and this demand. Right. And this supply is kind of a trap. I mean, this demand is a trap. You see the trend line? Perfect. 1 touch, 2 touch, 3 touch, we start getting a reaction. So this is some form of manipulation from the banks before we had this major sell-off. So this area is very, very interesting as well, because we could simply just take we could simply go short from here. But like how we trade, we don't want to be taking a position here because this price could be met. So we don't want to take a loss down here. It's not worth it. It makes sense, but there's a high probability that we have a movement where price keeps trickling up. Then we could have a reaction like that and go short, or we could just have a little reaction, continue coming to this, maybe have a little distribution type thing forming, and then go short. Because overall, we want this target to be met. So this is kind of our draw on price. This is what's pulling price down because there's unmitigated orders, etc. in here. And as you can see, like by chance, our level here lines up with a whole number. It's 1.2100. So that's a really, that's a nice confluence for us. So we might get a reaction from that. Right. So that's what I see for EU for today.
Okay.
I'm hoping we can see that trickling up and then continuing down. I really think that will hold. Okay, let's go to USD CHF. I'm going to start on the 4-hour time frame again, maybe the daily actually. Okay. Remember what we spoke about last time on USD CHF?
Yes.
So we're going to trade below these equal lows, come back into one of the origins and go long. And that's exactly what happened. That's just because it's so simple that we understand that obviously we created that liquidity here. We're just viewing this from a 4-hour point. Liquidity, we're still in an uptrend. The only logical place is the origin or the reaccumulation to play off of after we take out this liquidity. So that's really important. That's what you always want to see. Create liquidity, run below that, and then continue long. So unfortunately, if you didn't get in over here, so USD CHF is nowhere where we want to be trading now. We're not going to be looking for positions anywhere here because there's no point. It's not worth it for us to take a risk because we've already had the bullish rally, right? We're probably going to make a new high. So we can expect price to create a new high. So we can expect price to break above this high. But the issue is if you take a long position here somewhere, you don't know if price is first going to pull back, mess around, have another reaccumulation and then go. So it's not worth it taking risk in this area because the market's already extended to the bullish side. We've already had quite a large leg. I mean, this was you see, we've already had a 230 pip move in the bullish direction. So it's not worth it looking for another bullish opportunity now, unless you have a significant pullback. And it's also not, you can't be looking for a short position either because price has consistently been marking up. You can see, I mean, high, high, low, high, low, high, low. We keep making these high lows and we should continue up. Now, it's very important that you don't make this mistake that a lot of people make because they'll be looking at the daily time frame and they'll be saying, oh, look, we had a low here and we traded below these lows. So now we're bearish. So now they're going to be looking to sell these areas. And that's not right. That's how traders take a lot of losses because this isn't truly bearish price action. This is a leg that caused this up move. This is just a structural point. That's a reaccumulation like we always speak about. So why would you be wanting to take risk here? There's no reason, right? Even though you invalidated that, and if you look at the 4-hourly, a lot of people think, oh, it's in a downtrend because look at the 4-hourly structure, right? High, low, lower high, lower low, lower high, lower low, lower high, lower low. And now everybody's thinking, oh, shit, we're bearish. Okay, let's take sells all the time. No, we're not bearish because if you look at the daily time frame, and if you actually just look at the legs, right? Leg, complex pullback, leg up. So these moves that look like a lot of people will be saying, oh, USD CHF is bearish, or we had this bearish move. This move is just a complex pullback. It's not a bearish leg. Just a pullback that's very, very like complex. We had a big pullback and we took out this liquidity here, but the origin is still resting right here. That's what we tapped into. Does that make sense?
Yeah, very clear, Charlie.
Lovely, lovely. Do you have any questions for me?
The question I have is how you mark your point of interest.
Okay, so how do I determine points of interest?
Yes.
Okay, so I'm looking for a few things. I'm going to go over here and we're going to start drawing. Okay, so obviously we're going to be looking at multiple time frames, but let's say we're on the daily time frame, right? And we're bullish. We're creating these like legs up, marking up, and then we're creating these new highs. So I'm always looking at the origin of these moves. So let's say we were, let's say we were bearish before this, we came into this area. I just want to delete that. Okay. So before this, let's say, for instance, we were bearish, right? And now what we were going to want to be playing off of is our accumulations that took place before we had a break of structure. So let's look, okay, let's say this was our previous high here.
Yeah.
And then we created a new high here. So what are we going to be looking at? we're going to be looking at this area this is going to be our first accumulation, right? So this is going to be the area that created the whole like bullish move. We're going to call this the origin. So this is the origin of our bullish move.
Right.
Now, the most orders are going to be tracked here. This is where banks place the majority of their volume to get into the position. So we know we're going to get a massive reaction off of this area when we trade into it, and that we're going to come and test it. So this is your highest probability zone. So original origin of our bullish move, so original accumulation where banks and large hedge funds got in. Right, we had the break of structure, pullback. Now we're coming to test that, maybe close some orders, open another position. This is where we're going to be looking for fractal accumulation. So drop here, look for fractal accumulation on a lower time frame. Writing in notes to make it easier, lower time frame. Okay, so over here we're always going to be looking for fractal accumulation. And how do we know where to look for this fractal accumulation? Well, it's quite simple. We know we had one accumulation here, right? It's normally just a normal simple accumulation schematic where we create liquidity and then we run it out. So let's see this as the daily time frame, and then we look at this maybe as the hourly time frame. So in this area, maybe we had some price action like this. Okay, so this is, let's say this is our H1 time frame, and we let's make everything simpler. I want to put a rectangle over this one, and I'll make this maybe red in color. So we know that this is what's happening on the daily time frame. All right, now we know this is a daily time frame, and this is H1. Okay, now. And now we're looking, okay, so this is our daily time frame, POI. And now we're going to be looking at H1 to kind of determine in this area. So this is happening right here in the origin. Now we're going to be looking, okay, what happened here? So we obviously had equal lows here or something. We created some form of liquidity here. And then this move here liquidated it, right? So we traded below that whole move. So over here, we had a liquidation take place there. So that's going to be our POI. Or, right, if this mitigated this move, so right, the pullback, if that mitigated, we can look for something else in here. We can look for imbalance, or we can look for an OB, look for imbalance or OB, or there are a lot of things we can look for, but most importantly, we look for imbalance. Sponsor candles, right? So a candle that swept liquidity. Candles and OBs. That's what we're going to be looking for in like on H1. And then once we've determined that on H1, and we're going to drop down an even lower time frame. We're going to drop down to M5 or so, M1. And then in these areas, right, we're going to be looking for breaks of structure. So it'll look something like this. So if we're on M1, and let's say we come into this area, we're trading, obviously we're going to be we're having a pullback and we're pushing down, right? And now we're coming into that area. We're going to see some reaction, and then we're going to start chopping around most of the time, creating a new schematic. And then a lot of times what we wait for this lower time frame accumulation to take place in our higher time frame POI. It's really important to do that. If you wait for a break of structure, that's probably the most important thing I've learned. Is if I set my POIs on the daily, right, then refine on the hourly or refine on the 4 hourly, get a smaller POI, get a better picture. And then when you trade into that, maybe that H1 area, the H4 area, drop down to M5 and drop down to M1 and wait for a break of structure to occur. Because that is the biggest problem with smart money traders and Wyckoff traders, right? They place their limits on the higher time frame a lot of times. And sometimes we just have a candle, a volume candle going straight through that sponsor candle. We have no form of pullback. It's just straight to liquidation. And I believe a lot of traders struggle with that because they don't have the patience or maybe not the time to drop down to that lower time frame and just monitor price action. Because this confluence we have, right, if we see the same thing on H1 and then we see that accumulation schematic taking place on M1, right, creating liquidity again, running that liquidity out, breaking structure, pulling back to the 50% or the 80% of that liquidation that took place, that's what we want to be doing. And that allows us to have a much smaller stop loss, right? You have the same area that you're entering, but your stop loss is 1/10 of the size because now you're playing off of this break of structure here on M1 in your area that you think price is going to go long. That just allows you to refine your order so much and get in at a much better price and a higher probability move. Because price is fractal. So whatever's happening on the daily, right, you see the same patterns occur on the hourly, and you see the same patterns occur on the 1 minute time frame. Continuously, the market's just generating liquidity, running liquidity out, filling orders, and then going in whatever direction was intended. So we just see that constantly occurring. Yeah, do you have any questions about this, how I look for these POIs, or is that clear?
No, it's very clear. The way you've explained it, Charlie, it's quite clear.
Oh, lovely.
So it's identifying your zones on a higher time frame, then you go to a lower time frame, and then look for those breakout structures on those specific points of interest.
Exactly. In your POI, wait for a break of structure. And then obviously the concepts we use, we're looking for imbalance falls, we're looking for OBs, we're looking for sponsor candles. And then pretty much we just follow mitigations, and then you're there, you're set. And this is difficult to learn in the beginning, and it's difficult to get the patience for it. But once you start looking at the markets in this fractal nature, it really does change your trading. But it does take a while to get a hang of, so don't ever get discouraged. Just keep trying and practicing. And the best thing you can possibly do is hop onto TradingView, maybe open a Google Drive or something, and just backtest, right? Follow these concepts, write yourself a set of rules, and then backtest, take the trades theoretically, right? Write down, take a screenshot, write down your entry, your stop loss, and why you entered. Explain the trade to yourself. That's the most important thing. If you spend 10 or 20 hours a week, I know that's a lot of time doing that, you're going to start building up a massive journal, right, of past trades. So keep testing, build that journal, and what starts happening is your mind automatically starts recognizing setups that you like. So it's not going to be tedious anymore staring at a chart trying to figure out what you're doing. You've done enough back testing and you have enough inputs into your journal, hundreds of thousands of trades. That's going to be imprinted into your mind. You're going to be able to look at a chart and say, okay, is price where I want to be trading? Is there anything I like? If yes, then you drop down before the analysis. If no, then you're done. Your analysis shouldn't take more than 10 or 20 minutes in the morning, and then you can do your day. Set some reminders, right? Set where, okay, if price comes into this area, TradingView or MetaTrader can just send you a message and then you're good to go. That's what I believe. I believe you shouldn't have to sit in front of your charts all day. You just have to wait for price to come into an area where it's worth trading and where it's worth taking risk.
Just to ensure that we are aligned on the concepts, Charlie, what do you refer to as a sponsor candle and what is OBS?
Okay, so OBs are just order blocks. Do you know what an order block is?
I know institutional candles. I don't know whether it's the same.
That's pretty much the same thing. So, we can look at USD CHF. It will be clear here. So let's look. Okay, we had equal lows.
Right.
And then this can kind of be considered an institutional candle. It's a sell to buy movement that runs out liquidity. That makes sense. So it's just like volume candle that runs out liquidity, and then it's followed by a candle pretty much of the same size, etc. Volume candle as well in the opposite direction. It's like boom, boom, up, down, back up almost immediately, just to run out these lows. So this isn't a really pretty example of a sponsor candle. It doesn't look very good because of the price action here. So I just want to look for something looks a little bit better. And always after your sponsor candle, you want to see a break of structure. That's very important. Very, very important. So this can be considered a sponsor candle, but break structure. Sorry, I want to look for a clean example. Do you know what's the best to look at? If you want to see the most beautiful, like smart money concepts and Wyckoff taking place, look at Nasdaq.
Nasdaq.
Yes, NAS 100 really follows smart money concepts well. All right, so check this out. This is a sponsor candle. So here we have an OB that's sell to buy, and here we have a sponsor candle where we created liquidity, created equal lows on the daily time frame. So a lot of traders are buying this area up. Then we sold off very rapidly and bought back up and then broke structure. So this candle was a sponsor candle to run out the liquidity. And then you can see on Nasdaq, you'll see hundreds of examples. Like over here, you had another one, all these equal lows here, run out, go long. Happens all the time, especially on the lower time frame. Like, it's really nice trading Nasdaq. The best trade Ariel's we've ever taken was on Nasdaq. The highest RR. I just want to go and show you a schematic taking place. And let's look. Nasdaq's been so bullish, it's crazy.
Yes.
Yeah, we had equal lows, we had that manipulation. You can maybe look at a different time frame to make it clearer. Okay, so obviously here we're manufacturing liquidity in this area. All over here, we're manufacturing liquidity, creating all those equal lows. You see what happens? Once, twice, 3 times, 4 times, 5 times, 6 times. Equal lows, keeps bouncing. Right, so every time that happens, there are traders getting in here in buy positions because Nasdaq's bullish, right? It makes sense to buy. This is considered extremely strong support, and it's considered a demand zone. So traders just simply put their stop losses below these areas, thinking we're going to be fine, but price is going to go long. Then we always have that move where liquidation takes place right there. Look at that. Sell, and we start buying up immediately again. Now look how cool this is, right? So here's our structural point. This is our supply zone that created this break, right? This supply here. So if this supply zone doesn't hold, right, we create equal highs and we break above it, we know that this is a sponsored candle and we want to enter. So look, so that's not, it's creating equal lows. So now we pull back, right? Remember what I told you, the 80%. That's the highest probability area for a sponsor candle to hold. Now we know, let's look, you always want to ask yourself, which candle, right, liquidated the traders? It's this one. Because this candle broke through our demand zone and then the next candle bought back up. So that's our area that we want to be trading with. So here's our 80% of the sell to buy. So this region has a high probability of holding. And what that allows you to do is have an incredibly small stop loss, which is obviously very good for us trading high RR. Now let's look at that. So on Nasdaq, you've got a $3.4 stop loss. That's absolutely nothing. And you can target, what I always do is I target a previous high. When we've had like this kind of manipulation, you always want to be targeting a previous high, or you can go over to your higher time frame and look what's interesting me. So over here, I see we've got equal highs, right? Now, I know that liquidity is resting there, or we know that liquidity is kind of resting in this region. So we expect price to meet that. But what I also expect price to meet is what we always speak about, kind of that 50% of a buy to sell movement that took liquidity. So we know this ran out something. And then let's look, what else is here that's interesting, right? This supply is very, very significant. But then let's think, which supply broke this demand, or the demand coming in here? Well, it's this supply here. So I really like this area for short positions too, because there's always a chance that this can hold. So wherever you think it's a good place to go short, or you would go short in the market. So I'm saying I want to go short from either here or the 50% of this move. So, or here, okay? So this is where I think price is going to go short. So what are we going to do? Play it safe. At the 50%, we'll set our TP, TP2. TP1 is at these equal highs. TP2 is over here. And then we can set TP3 at the supply zone. Yeah, simply at that pin bar candle, because we also believe that has a high probability of holding. I really like trading off pin bars. So now you need to see your, while taking profits, firstly, where you take profits and where your stop loss is more important than your entry. I believe TPs are much more important than where you enter. So you have to have you have to take TPs at places where you really think, okay, this is where I would be willing to go short in the market. Or it doesn't make sense. Like, why would you take profits if you're not going to be a willing seller there? Because that's basically what you're doing. So the thing is, a lot of people, once they're in trades, they get nervous, they get anxious, they think, oh, fuck, it's going to go against me, or something's going to go wrong. I should just close my position and take profits. But the issue with that is, and that's why so many Wyckoff and smart money traders are unprofitable, is you'll take 3 or 4 losses in a row. And then once you took a good trade, you're going to close it at like a 2% gain or 1% gain because you're scared. You don't have the psychology. And that's what fucks people over every single time. It's just not having the psychology to understand this is a good setup. This should hold. Even though your previous 4 or 5 trades didn't hold, it's still a valid setup. If you follow your rules, you'll be fine. Take profits at logical places and place your stops at logical places. Only TP on a buy position where you have confluence to sell. That's important. Don't just put your TP in a random place or close your position because you're getting scared. That's the biggest mistake you can make. All right, so we didn't trade into the 80%. That would just be a miss, unfortunately. But anyway, let's look what price does for interest rate. Okay, you see that? Straight off the pretty much the 50% of this move, or close to it. Well, this area, right? Here's the 50% of this buy to sell. Remember what here? Buy up all the way to this point. See that? Here's the 50%. Okay. Look what happens to price. Once we tap that 50%, we immediately kind of have a reversal, right? So that's what I was saying. You want to TP at logical places. TP here, and maybe this is our next one. Now, this was just a reaction. This accumulation schematic that took place here is much more important or much more significant than these areas. So don't think you can take a short position now at all, because that's not the case. Firstly, we haven't broken structure at all. We're still very bullish on this move. And I believe we're probably going to continue long. So as you can see, look what happens when we hit our second POI. You see the reaction again. We tap it, and immediately we have a massive reaction to the downside. So that's why I believe like the areas where you TP is incredibly important, like TP in logical selling areas. And there we go, pushing up, making a new high. Does that make sense?
It makes a lot of sense. So would you advise that perhaps so that you don't miss on your 80% retracement, can you take your half position at 50%? And
yes, so you can take, exactly, you can take your half position at 50%. It's just, I would rather get into the trade with a smaller stop loss, right? And then my risk to reward is much bigger if I get entered, because a lot of times I will get entered. And if I don't get entered, it is what it is, you know. You look at the trade, my mistake with analysis. My rules tell me to trade off of the 80%. If we don't trade into that, then, you know, it is what it is. Like, there's not much I can do about that. Just take it as a learning curve. Because other times, you know, you'll trade into the 80%. Or if you place half risk at the 50%, right? Your stop loss is obviously going to be much bigger.
Right.
And trades where it just goes straight through that 50% and maybe reacts off the 80%, because that happens a lot. Go through the 50% and we react off the 80%. That reaction, because your stop loss is so small, if you're using the 80%, that reaction can get you up 1 to 2, 1 to 3 really, really quickly. Like, so you can have a 2 or 3% gain, move stops to break even, and maybe take a little bit of partials, be trading off the 80%. Whereas if you took the position off the 50%, you need a much bigger move. And that reaction might not be big enough to get you up a 1 to 1 or 1 to 2 to take profits. So getting in a bit earlier might actually get you, like, cause you a bit more losses, and you just need a bigger reaction. Because the thing is, trading smart money concepts and Wyckoff, the reaction is almost guaranteed most of the time. If you're trading like this, dropping down on a higher time frame POI, coming onto a lower time frame, you're going to get some form of reaction. And trading off the 80% just allows you to actually make money off of that reaction, or get risk-free off of the reaction alone. And that's what I like a lot. Is that we always see some form of reaction when we come into these smart money concept zones. It might not be huge, but that little move can get you, like, get you to break even, or like secure a little bit of profit for you. Okay, what do you want to go through now?
Now we can go through the other.
We'll
go through EU. We go through GU.
Okay, GU.
Gold and AU.
Gold and AU. Okay, it's going to do that. I'll be back in 1 second. I just have to fetch something.
Okay.
Okay, I'm back. So let's go to AU. I'll put my camera on in a sec.
Recording is still on, Charlie.
Yes, sir. It is indeed. Okay, let's go. Again, we're starting on the daily time frame. Now, I just want to remove all my drawings. Okay, right, look at this. This is what we marked off last time. Entry, this is where we want to be entering, right here. So unfortunately, I'm going to show you this. This was very sad. In the Wyckoff chat, a few weeks ago, I sent out an AUD, not AUD USD, but AUD NZD trade. And it really made me depressed, because we missed it by about 2 pips, I think. Let me show you where this. So this is AU, right? This hasn't taken place yet. This is what I'm waiting for, because we have accumulation that caused a new high. So exactly what I was teaching earlier. Origin, we have our reaccumulation taking place there, and it tests the initial accumulation. And then here we have our second reaccumulation, and we broke counter trend structure here. That makes sense?
Makes sense.
So we're waiting for reaccumulation to the second reaccumulation that tests the initial reaccumulation. So we want price to come into this area, chop around a little bit on the lower time frame, and then go long. Anyway, I'm just looking for, it was on AUD NZD. It's GJ. Oh, this was a lovely trade. This GJ trade was crazy. Oh, here. So on AUD NZD, this missed our entry by 2 pips, this swing trade. Because again, like I was teaching, we have the origin, right? The origin of this bullish move, complex pullback, and over here we expect the price to go long. So unfortunately, I think if we look at AUD NZD, we missed it by what must be a pip. So let's go to, I'm going to go back to AUD, then we can come back. I just want to explain my logic to that trade to you. All right. Oh, it actually triggered. Pull back. Right, I think I can't remember. No. Anyway, this was a really easy trade, because you see how we broke above this supply zone here, kind of broke structure, that last push. And on the higher time frame, we're kind of bullish, right? Made a new high. So we expect a reaction from this area, and it's really simple what you can do. So over here, right, I identified on the lower time frame, I identified a POI, and it was on the 4 hourly. And I'm going to show you what that POI was now. you can see on this time frame that the entry actually missed by 2 pips. Very sad. But anyway, yeah. I hated when that happened. So check this out. This was my logic on this trade. Okay, so I entered again at the entry 1 was at the 50%, like you asked if you can do that. I did that in this instance, and entry 2 was, as you can see, at the 80%. So it just missed our 50% entry, but it's okay. It's not the end of the world. But the logic behind this trade was this sell to buy, right, on the 4 hourly. We sold off, and then look what happened, right? It's the same concept, like occurring again and again. We have equal lows, 3 of them. What happened here? We swept that liquidity, right? Traded below those equal lows and removed these traders from the market. So we created liquidity again. So I considered this whole move here as an institutional move, and it wasn't mitigated. So it was a very logical place to take risk. And I mean, we missed the entry by 2 pips, but this is up probably a couple hundred pips. Yeah. At its peak, it was up 125 pips. So just it shows you how cool precision trading is and what you can actually achieve. But sometimes, like this, when you are trading with precision, you do miss entries by a pip or 2 pips, and it breaks your heart. But other times, you pull off amazing trades. So I'm going to go to AU now, and we can have a chat about that.
So what would have been the risk to reward for that?
For this previous trade?
Yeah.
On Aud Nzd, the RR wasn't high at all. For me, this was kind of a swing trade. So I was just going for 1, 2, basically 3.
Right.
That was really easy. I just wanted to swing that one. Because I couldn't, when I was looking at Aud Nzd, I couldn't find confluence on a lower time frame. So on M5 or M10, I couldn't find anything that I was interested in. So I just used the 50% of this whole leg. Aud USD. There we go. Okay. So for Aud USD, I've been sitting on my hands, like, I don't trade unless we come into my points of interest.
Yeah.
And the only time I'm going to be trading is when we come into this area here. And that's the only place I want to be trading, because at this point we're bullish, right? So I don't want to be taking a short position anywhere here, because, right, it's not to say that we're necessarily going to come into this area and react off of my zone, right? This area here, this sell to buy that occurred here, selling off to buy up, this could have already mitigated this here, right? And we can see a wick. After we ran these lows, we had a wick pulling in here, right? So maybe this is the last unmitigated move, right? And as we can already see, I mean, it's the same concept over and over again. What are we reacting off of here? Right, as simple as it. The 50%. It's crazy, right? Of a sell to buy. So, and look at the sell to buy. You see, we had equal lows forming again.
Yeah.
Low, 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 low. Sweep below that and then continue, right? So we took out that liquidity. Now, look at that. We just simply react off the 50% of that move. The sell to buy, sell off to buy back up, that swept liquidity. It's as easy as that. And this is what I identify all the time. I look, okay, we created liquidity. So it's called liquidity inducement. We made liquidity. We took that liquidity out of the market. We took those traders out of the market, and then we bought back up. It's as easy as that. Now we look at this and that precision. The 50%, obviously the average order value of the sell to buy, this leg down. And then if you had that marked up, right, on the lower time frame, you can just see that's a beautiful reaction. Absolutely lovely. So now where are we going to trade into? So here's a little supply zone. And then I really like this up here. That's also a nice supply zone. But as I was saying, my strategy only allows me to trade over here, the origin. So I'm going to have to wait for price to come into this area first, unfortunately. So I'm still going to have to be patient and just wait for price to meet my area. So if I look at this, right, I can clearly see all this liquidity building here, and then look at this 12-hourly candle. So I'm going to want to be entering, like always, at the 80% of that 12-hourly candle. But look what the issue is. Right? Sometimes you kind of have other candles trading into that. You see the wicks coming into that area, close to the 80%, that wick there. Right. So that's concerning for me, because I don't know, have the banks closed these orders, right? Have they mitigated their short position with these little spikes down and maybe this move down, or have they not? So that's the issue. That's why you have to wait for a break of structure, because you can never be sure if this has mitigated this move or not. So you have to wait on the lower time frame, wait for that confirmation in your area, wait for a break of structure, just to increase the probability of your trade being successful.
You must be very patient, Charlie.
Extremely patient. You have to, the thing about trading is a lot of people's downfall is just their psychology and their patience. Because obviously there's that psychological thing. Trading like kind of gives you the same dopamine response and the same feelings as gambling, and that's really addictive, right? A lot of people are addicted to gambling and love gambling, and people who start trading and don't really know what they're doing get that same feeling, because it feels like, I don't know, it feels like you're gonna make a lot of money, or you kind of feel like you're gonna hit a jackpot in a sense with your trading. And that's just not the case. Like, look at casinos. Nobody's a winner if they're gambling, right? You're always going to lose. And that's a massive issue. So by just placing reminders at areas of interest, you're really taking out that aspect of gambling, because you're following your rules and you're waiting for price to come into an area where you know you can take a trade and you can take a successful trade. That's the most important thing for me, is just being patient. Everybody lacks patience. And unfortunately, kind of the 21st century and the day and age we live in now, everybody's looking for instant gratification, right? If you do work today, you want the rewards right now. You want to be paid, or you want to take a good trade immediately, right? You're working today, I want my reward. Right? I spent 20 hours backtesting yesterday, now I want to take a good trade today. Or now I want to be a professional trader because I spent 2 months doing courses. Unfortunately, that's just not the reality. Right? You're going to have to put in a shit ton of work. It takes everything out of you. And I really think trading is one of the most difficult jobs in the world. It's just mastering your psychology is not impossible, but it's a massive task. And then beating pretty much the world's biggest market is another massive task. And you're only going to get that right if you have very thorough rules and you adhere to those rules, and you set your reminders, you wait for price to come into places where you want to trade. Because constantly, right, it's called liquidity inducement, right? Banks constantly want you to take positions because they want to fill their orders, brokerages want to make money, etc. So the whole time, if you're monitoring price in these areas here, you're going to see things the whole time that are going to make you want to take positions. And so anywhere on the chart, you're going to see some form of something that's telling you to trade. And so if you stare at your charts all day, even though there isn't a setup, you'll find one, or you'll create one in your mind. And that's what a lot of traders do. They just look at the charts for hours and say, oh, okay, this happened, that happened. Because like, look at this, for instance. On the 5-minute time frame, a lot of people are going to say, oh, look, we're bullish, we're making higher highs. Maybe they're saying that this was a run on liquidity. So this was a test. This is an origin, accumulation, test of that accumulation. Now they want to look for a long position here somewhere. And that's what a lot of traders do, because if you stay at the charts long enough, you're going to find a setup, or you're going to make the setup meet your rules. That's the biggest issue. So people are going to be looking at the setup, and then they're going to try and make it work, try and like make something out of nothing. And that's the biggest issue. When you start creating your own confluence in the charts and you start seeing things that aren't really there, that's when you're in a terrible position.
I can't agree more with you, Charlie.
And a lot of people do that. I found myself doing that. When I started trading, probably the first year, I would just create my own confidence. I would look at the chart and be like, okay, I see this, see that. Okay, let me take a long position. And fortunately, if you journal your trades, you really start. That's also something that you have to do. Journal every single trade you take. Take a screenshot, right, of every time frame you're looking at and write a narration explaining why you took this trade. And if you want to, you can go and spend some time backtesting, right? Take screenshots, please. Write down your analysis, and then you can send me those files. Maybe put it on a Google Drive, and I'll check it out, and I'll let you know what I think. So if you want to put in some time, I'll do that for you 100%.
Good.
Hey, awesome. Hey, maybe let's go to gold.
Gold and the GU, and then I think.
Okay, gold and GU. Okay. So where were we on gold last time? We marked off kind of an area where we were expecting supply, right? That's what I remember last from gold, and we did get a reaction off of that, but we had news, so we kind of continued long.
Yeah.
Now, what do I see on gold? Okay. Let's go to the 4-hourly. Okay, so now we already have a few POIs on the 4-hourly. So firstly, we expect gold to make a run, right? We expect shorter price, like gold going short because of these equal lows.
Yes.
And we want price to come take that out. And then if we go to, I want to go to the daily time frame and show you a few things. Okay, so firstly, we have liquidity resting here. Secondly, right, let's look at price. Let's look what's been happening. So, you know, like these reactions here, it's quite simple to see what kind of caused them. And that's this move here, sell to buy, and we swept some liquidity, right? We took out a low, these lows, this low, and this low here. So we're kind of just reacting off of this area the whole time. And if we pull a fib on this move, like we've been doing the whole time, okay, what are we reacting off of? That's the question. And it's probably, you see that, that's the 80%. So that's when the 80% comes into play. Not always, but like in this instance here, sorry, I don't have anything marked up because I don't trade gold very often. But that's what we reacted off of. That 80% move, the sell to buy, that swept liquidity, swept prior lows, low, 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 low. And we're reacting off of the 80% of that. That's why I like placing my entry at the 80% because it just gives you such a small stop loss. The stop loss is going to be resting below this wick here. But anyway, now over here we have our drawn liquidity, right? And then let's look at price. Here we had an accumulation take place for sure in this area because this isn't the origin of this whole move, but this is where I would want to take risk, right? Because this is our lowest point. We need a massive pullback to come into this, and we can definitely see a reaction here. So this is what I'm going to be waiting for price to come into. This area here. Or, okay, I'm going to show you now what I also really like. Just something that looks very, very appealing to me is this move here, the sell to buy. Again, look, remember we're on the daily time frame. So there's a lot of price action occurring on the lower time frame. You see the liquidity resting here, low, 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 liquidation, push up. So this area here is very interesting to me because I'm going to show you, well, I'm going to explain my thought process and I'll show you why. Okay. So what I think is going to happen, and what's more than likely going to happen, is we're eventually going to trade down. We're going to take these lows out, right? And what normally happens is we're going to see something like this. This is kind of my prediction, right? So we're going to have obviously this push up. We might push above this high, or we might run into supply here somewhere, start messing around and coming down. Right, we're going to come through these lows. This won't hold again. I mean, it's more than likely going to come through. Now, somewhere this market's going to be overextended. It's going to have sold too much, because we can't expect price to kind of trickle down or move in a linear fashion all the way here, right? That's not going to happen. So what's probably going to occur is we're going to come into this area and have a pullback into some form of supply here, any supply zone here. So we're going to move into some other supply zone, and then we're probably going to go short again, and then come into the origin and go long. Not the origin, well, a reaccumulation that took place. Now, if I have to look at gold and I have to think, okay, where can we go short? It's quite difficult for me because there's a tough situation here. We obviously have this kind of trend line that formed here in this area. We have these highs. So we might expect price to kind of tap here and then push through. So we might respect the trend line and then push above. But I can honestly at this point, I don't want to be trading gold because I just don't know what's happening. It's not anywhere where I want to be taking any form of position at this moment, because obviously it has to go short at a stage to come into my areas, and we know that these lows won't hold forever. But the issue is, like, I can't see confluence to take a short position. The only thing I can see is I would happily this kind of here, right? Because this is the demand that caused us to break all of the supply, all these equal highs. You could take a trade off of this. This is a high probability of holding, but it's not worth it for me, because if I take a trade here, I'm not sure if it's going to hold, because we have these lows here, we have this, and where will I take that trade to? So it's not worth it for me to take risk in this area, right? So we can monitor this and see what happens on the lower time frame, this area here, because we could have a kind of schematic forming here. We can pull back and mess around here and then go long to run out something here. But it's just not worth it for me because I don't have enough confluence to take this trade. Does that kind of make sense? Because it's just not worth it for me to take risk at all.
It makes a lot of sense, Charlie, and I must commend you for being very disciplined.
That's the most important part. You have to be disciplined, or you're not going to get anywhere. You can think about it, right? If you're trading like this, and let's say you want to take a funding challenge, or you're just trading your own capital, how many trades realistically do you need a month, right? You need 1 or 2 trades that hit. Like if we look at, what was it, GBP JPY, that I sent out this was a while ago now, but was this GJ? Yeah, GBP JPY came up after our entry and hit a 1 to 15. Now, you only need to take 1 trade a month, right? So over here, GJ, I took that off the 80%. So that's why the stop loss is so small. I entered at the 80%, right? And it hits a 1 to 15. So if you're trading like that, you only really have to take 1 or 2 trades a month, right? Because look at this. As soon as we came into the 80%, we had a massive reaction and we were up 1 to 2 in the matter of 3 or 4 minutes. Just the reaction gets you there. And that's what I really like about trading like that. And then here was the original, that was Aud Nzd, and here was the original analysis on GJ. We came into a 2-hour demand zone. See that generating liquidity. Again, we looked at that candle, the sell to buy, that took out the liquidity. I simply pulled the fib from the bottom of the candle to the close, well, to the open up here, right, and then placed my limit at 80%. And you simply take 1 trade like this a month that hits 1 to 15, and then you're done. So you only need 1 or 2 really good trades a month to maintain your FTMO or to pass the challenge. You don't have to take 10 trades. You don't have to take 10, 20 trades. You have to take 2 high probability setups, or maybe even 1 if you're lucky. So if you can wait for price to come into those areas and create what you want to see, what you know is going to work, what your strategy demands of you or your trading plan, then you can just execute that trade. Take a few a month. Right? If you take one trade a week, that's more than enough, or one every few days. It's not about trading all the time or scalping the 1 minute chart. Like, you'll see hundreds of strategies and thousands of people trying to teach you stuff, but it's just not the way to go about it, because people are trying to kind of teaching you things that will make you happy. Because if I told you, okay, I trade every single minute of every single day, I'm always in the markets and I'm making 100% a month, that's kind of what people want to hear, but that's just not the reality at all, unfortunately. And luckily, I think you understand that that's the right way to go about it, just being really patient and waiting for price to come into areas, because that just makes your life so much easier. When it comes into an area where you expect or know that price is going to have a reaction, it just makes trading easier, more pleasant. You don't have to be in front of the charts all the time. And it's very good for your psychology, because you're not going to be confusing yourself. You have a set plan and you're going to execute that plan.
Agreed.
That's okay. Most important. We can go through a few more pairs. What else do you trade?
Is it GU?
Let's pop into GU.
Yep.
Lovely. What was I saying here? I was looking for fractal accumulation. Okay. Move drawings. Now, GU again. This is a tricky situation. A lot like the EU situation, right? We're looking at the daily. So technically on the daily time frame, we are bearish, right? Created a lower low, created a lower high here. But now here's an interesting thing. Okay, this move here, this happened in COVID, right? This was the sell-off that was occurring in COVID on GU. That was when the dollar was rallying, etc. Now, I believe that we're going to make a new high, right? This is simply just a sponsor candle. Liquidated millions of traders, or at least millions of dollars worth of position, billions more than likely. So this is interesting for me. This is where I think we're eventually going to come into to create a new high. But for now, let's look and follow our rules, okay? If we just look at this bullish move, we're going to say, okay, over here, again, we have our origin of the move. We're going to mark that. Let's make it violet. So that's our origin. Then let's look for areas, right, that caused or like any significant break of structure. Okay, so now we're going to be saying, okay, this is pretty cool. Now we look at this move here. Let's make it yellow. So this reaccumulation caused a break of structure, right? We kind of created relatively equal highs, traded above all these supply zones, whatever. So this is a reaccumulation, a broken demand zone. So we know this is an area of interest. This is a POI for me. I like this a lot. Then let's look at the second area, okay? What else caused a significant break of structure? So this area here, this price action, caused us this reaccumulation, or second reaccumulation, caused major breaks of structure. So it caused major BOSs. So this is really interesting for us. There we go. So this is our POI, one of our POIs. So we're going to wait for price to meet this area, and then we're going to start looking for long positions again. And at this moment, we're not going to be looking for any long positions because, right, price is marking down. This is a complex pullback that we always speak about. But we don't want to be, even though this is a pullback, we don't know how long it's going to be pulling back for or where it's going to find support. So again, we're going to be waiting for price to come into this area here, and then we're going to take a long position. Now we're just waiting for this kind of price to find its way. So now we can also look, just for fun, I always do this, we can look for a short position here, not actually going to take one, but I'm going to show you where price is more than likely going to come short. Here we have our pin bar. That's a real and imbalance full at the bottom of this. I'm going to go to the 12-hourly time frame. We kind of see beautiful price action there. And let's go to the hourly. Okay, so here's our hourly area of interest, right? I think price is going to go short from here. And then if we tap a bit deeper into this POI, we can see that this was the last major supply in this area that caused our break of this demand here. So I really like playing off of those. So we mark off the 50% of that. So I really think we can have a reaction pretty much there at the imbalance fall too. So we can trade into this and then continue short and come into our POI. But yeah, at this moment, so we don't have a setup because we're waiting for price to meet our POI, our bullish POI, because price is bullish. So fortunately, we have a lot of pairs, right? There are 28 different Forex pairs that you can be concentrating on or looking at to decide where you want to be trading or what you want to take. So again, this is just a concept I've been reiterating and reiterating and reiterating. Look at GJ, right? What is this here? This move here, so reaccumulation, right? That causes us to like invalidate this high here, this high here, this high here, and this one, right? This little thing here caused all of that. So that's why, remember I said in that trade we took, it was off the 2-hour demand zone. So we took the trade off of this demand zone. So it gets really easy when you start to know what to look for. And it's just like, I repeat the same concepts over and over, but that's all that's important, is if you understand those fundamentals, you'll understand the market very well. Okay, let's go to, what else can we look at? GBP. Euro GBP, okay, for sure. There we go. Okay. Oh, look at that. It was marked off a few days ago. Again, that 50% simple, right?
Yeah.
On the higher time frame, and that's because we had liquid kind of trend line liquidity forming here. People kept selling this trend line because we are bearish. And then after we created this trend line liquidity, we created equal highs, and we know liquidity rests there as well. And then we simply liquidated these traders, everyone selling this, buy to sell. And then we had even more confluence here because we were saying, okay, here is kind of a significant supply zone. It lines up with the 50% of this whole move. So we know price is going to go short here. This was a really, really simple trade. Because, I mean, there's not much that you can mess up here. Liquidity, sweep of that liquidity. Look at the volume taking out that liquidity. A massive rally. Takes that out. Price break structure, right? Creates a new low. Goes long. And then, kind of, you need this is important. I'm happy you took us to Euro GBP because look at this. Right? On Euro GBP, we created kind of a perfect type 1 accumulation schematic, right? Liquidity, sweep of liquidity, that kind of created these equal highs, and then off we went. But we didn't take a long position here because firstly, price is bearish, and secondly, this POI that we had here is much more significant than this. Right? So we took a trade off of this. We don't want to be trading here. So that's really important because we are bearish. So a lot of people will try and take a trade off of this area here, take a long position, because it looks like a textbook setup, but they're not paying attention to overall trend, right? Because if you're just looking on the lower time frame, if you maybe were on looking at the 10-minute time frame, right? And you're looking at this, you're saying, oh, okay, look at that. liquidity, sweep, POS, continuing. So if you're looking at this and you're not looking at the bigger picture, you're just looking at this price action, you'll think that this is an excellent place to take risk. You're going to think this is going to be a perfect setup, but it just isn't. It just isn't the right place to be taking risk because of the overall trend. That's why top-down analysis is so important. Start on the daily time frame. That's where you want to start. Look what's happening on the daily time frame, and then from there you trade. Because now that we have our picture on the daily time frame, we can say, okay, we are bullish indeed. Now on the daily, look what we have. We have a lot of liquidity resting here, right? Yeah. A lot of relatively equal lows. So we can expect price to come into this area. Now, which area caused this whole rally? Origin, reaccumulation. Look at the volume. After we created, look at that. After that reaccumulation, massive volume. So this is where we want to be trading, in this area here. It's going to take a very long time for price to come there, but we can wait. Or if we maybe wick below, we can definitely get a reaction here somewhere, but that's just patience. And the thing is, like, even though a lot of our POIs are far away, they will be traded into eventually. Now, this was sad. I was waiting on EuroCAD. I waited a very long time, for months and months and months, for price to come into this. Because look, you see how we created liquidity, swept that liquidity, and then went long. So I was waiting for price to come into this area, but I wasn't sure if it was going to hold because you see we failed to make a higher high. Right. So now, because we failed to make a higher high, this didn't hold. But this, we kind of had a little reaction. Again, look, let me show you. So let's pull a fib. So that move swept liquidity. Let's cap the 80%. So when we came to the 80%, kind of price started like chopping around, right? But that just didn't hold. So that's because this wasn't the origin, right? The origin of this move, this thing that broke structure, was here. So this is where we should be looking to take risk. This area here, that's a much higher probability zone than this. So this is what I'm with. This is my next POI on EuroCAD, is this area here. Just want to see if we get a... Okay, perfect. I think, did we go over this together? Did we, on G-Chef last time? Yeah. Okay, because I think it was with, yes. So I pointed this out. Here, right, we have significant supply. Right. This demand broke that supply, right? So that's why this was my POI, to take a long position. Simple as that. I think, actually, oh, okay, you know where I sent it. What dates did I do? I wish I knew what dates I did this analysis. Probably in the beginning of November. So I'm gonna, this is gonna be a good learning experience, because one of the members in the supply and in this chat sent a trade they wanted to take on GJ and on G-Chef, and I explained to them why they couldn't. Okay, so this guy sent in, you see GBP Chef, he said he wants to take a short position here, right? And he just asked for some feedback, and this is what I sent him. I showed him here that exact setup. Reaccumulation that ran out significant supply, right? And that is going to take us long because it created this high. And that's why we reacted off of that area and went long. So I just told him, you can't take a short position here, even though it looks good, it does look good for a short position. You can't take that because of what's happening here, the higher time frame move. As you can see, we had a massive bullish rally off at this point. Well, not a massive one, but we had a couple of 100 pip move. So this is, see, we almost had a 300 pip move just from this area. And it's just these simple concepts that people don't look for. You just have to ask yourself, Why did that happen? Why did we create this new high? Well, it's because we had an accumulation here. This created that. It's as simple as that. So you have to understand that if we come into this area, you don't want to be taking short positions because the probability is that you're going to go long from here. You're going to have a bullish rally, and a lot of people don't understand that or don't look at the bigger picture. That's a problem. You have to always look at the bigger picture, because what he was doing was he was simply looking at the M5 time frame. And what happens if you just look at one time frame, or just look maybe multiple time frames, but the lower ones, you don't really understand or see or understand the bigger picture. So this is a bigger picture, what's actually happening in the charts. Whereas if you were just looking at the lower time frame, so let's go, maybe he was, I'm not sure what time frame he was trading on, but if you go and look at the hourly, look at that. We're very bearish, aren't we? Creating lows, new lows, new lows. So you can expect, what people are expecting is, okay, we're just going to continue short. Because look at that, price is going short. But that's the problem. It's because they don't take the time, or a lot of people don't understand or know about these concepts and understand the origins, etc. But they don't take the time to understand and ask, why did we create this high? Why did we create this high? Well, we created this high here because of this accumulation. So we understand that this accumulation is obviously going to cause a massive reaction. That's what I'm just trying to reiterate, is you need to ask yourself those questions and actually ask, why is this happening? And where should I take risk? It's a thing. Well, I'm always waiting for the right opportunity. And as you can see, they hold. Yes?
That's why I want to understand the structure very deeply, so that then if I have to wait for that one trade a week or one trade in 2 weeks, so be it. But I really want to understand the structure. I want to understand the accumulation and reaccumulation zones, and then improve on my patience.
Exactly. Like, you'll see it's going to get easier and easier for you. Like, as we do these sessions, like this is already, I mean, for me, this was like, I didn't have to think about this. Literally, I get, it's kind of, what do you call it? It's instincts now already. You just understand, okay, this is what's going to happen. This is why. I'm not always right. Obviously, I make a lot of mistakes, but I'm right enough of the time to keep me in the game. And that's all that's important.
Good. Now, Charlie, I signed off for the Wyckoff EA.
Oh, yes.
Last night. Now, will you be taking me through that, or will it be?
Yes, for sure.
You'll be taking me through that.
Yes, yes. I'll help you with setup after the call.
So normally, how does it work? Because once you sign up for an EA, you definitely need to be taken through to understand it, and also to basically implement.
The EA uses the concepts I taught you today: the sell to buys, the liquidity runs, and uses multi-time frame analysis, and then volume analysis as well.
Yes.
But I'll explain it in depth to you, and I'll help you set it up. It's passed a few FTMO challenges and funding challenges, so it will be, if you want to just pause and give it a try, you can for sure. I'll help you set up the right settings, etc. And then after you've passed, it's your job to maintain the account, taking 1 or 2 trades a month. Like that's my logic. If you make 3 to 5% on a 100K account, it's more than enough money to live. 3 to 5,000. Yeah, exactly. Me too. I'm happy. I can go and live in Bali. I can chill. I only have to work a couple of hours a week. And that's what we're all working towards. That's the thing, like freedom. That's all I care about. I want to work for a few hours a week. I want to decide when I work. And I'm chilling until price comes to my POI. But then I'm there. I'm switched on and I'm ready to trade. I'm doing my thorough analysis. But when price isn't in any of my POIs, and as you can see, my POIs are always quite far away from price, I'm doing my own thing. I'm hustling with different businesses. I'm working. I'm learning. And that's what I believe everybody should do. As soon as you understand that concept and you understand to wait for the right areas, you have a lot more free time. And what you can do in that free time is improve your trading. You can backtest, you can journal, you can create hundreds and hundreds of journal entries for previous trades. And then once you go through them and you look at them, go through every single one, write down what mistake are you making? Why are you losing trades? You'll start seeing common characteristics in your losses.
Yeah.
Right? You start seeing those mistakes. You start identifying, okay, I did this wrong. And then once you understand that, and you're only going to understand that through backtesting, then you know, okay, I shouldn't be doing this, I shouldn't be doing that, I should be doing this. This setup held. Okay, why did the setup hold? Why was this better than that? Then you start understanding, okay, that's why, because I took this trade off the origin, but there was a fractal accumulation in the origin, that's why I took it, and that's why it held. Whereas the biggest problem is a lot of traders try and improve their trading while they're trading live. Obviously, that's one good way to go about it, but you take much less setups. Maybe you take 2 or 3 live trades a week. So that's only maybe 2 a week. That's only going to be 8 a month. So you're only going to have 8 opportunities to learn in that month to understand maybe what you're doing wrong. Whereas if you're backtesting on TradingView, you can have 100 opportunities a week to learn. And that's what's important, those learning opportunities.
So how do we structure these Wyckoff EA so that then we have like a plan so that it also allows you to do your other things. It allows me to do my other things.
Are you free tonight? For maybe
tonight? What time?
Anytime. I'm free all day. I'm just gonna be I'm always kind of around. Just need to let me know and then I can work with you.
Let me see. How's 7? That would be 6 p.m. for you?
Yes.
How is that? Can we structure one at
yes.
7?
7 your time. Perfect.
7 my time. That would be 6 your time.
That is perfect.
Super.
Okay, lovely. I'm going to send you the recording.
Yes.
Let me just stop this.